I don't think any countries around the world want to get in this huge, big trade war because everybody loses basically. So
And welcome into the program. This is your game plan for retirement, Northwestern Ohio's resource for a common sense approach to planning for your financial investment and retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire, always a pleasure to have you along for the ride. Chris, it's the time of year where I think people are looking at the end of the school year and planning summer vacations. Is that a little bit more of a challenge when the market is behaving the way that we've seen recently?
I would think, from especially on the real estate side, because in springtime is when a lot of people put their houses up for sale. They can
Right.
move the family over summer, and obviously, if you look at existing home sales, they're down significantly this year, and some of that's going to be an interest rate environment question, but some of it's also going to be the turmoil with the tariffs. Is that going to lead to some layoffs and job security? So. I got a good buddy of mine is a realtor, and we have breakfast every Saturday with a group of other misfits here in the area. And I say that jokingly if you're not watching the podcast there. And he said that look, he could tell people were hitting the brakes, and it's certainly becoming more of a buyer's market than a seller's market. So if the real estate market's struggling, prices are going to continue to drop until to attract the buyer. Where before, seller could list the price they wanted, basically, the market was hot. So, on the investment front, Peter, if that's where you're asking, not necessarily a big difference in our business practice. If we look at July and August, now we got a lot more people on vacation, but May and June still pretty normal. And I think intentionally we try to slow things down just a little bit there in July and August because you want to enjoy life and the good weather that we get up here up in the north, of course.
All 2 months of it. Yep.
Yeah.
Well, I know tariffs have been the dominant headline, but a sub topic there has been the interest rates, and there's been some debate back and forth politically about where interest rates should be. That certainly could help to stimulate the economy because the housing market, Chris, that's a huge part of our economy. When the housing market slows down, there's a ripple effect through consumer goods and refurnishing and services that go on with those new home purchases. There's a lot of things that get tied in there.
Absolutely. I got a pretty wide network. My brother's a manager at Appliance Center, so they're in the appliance business. They also sell furniture, and obviously, when the housing market slows down, like you said, so does the consumer goods. People don't buy laundry machines. They might not be buying the sofas and so on and so forth, doing the remodel. It can affect Home Depots and Lowe's because people are spending less money there. And hopefully, some of this gets short-lived and we get these tariff pieces behind us. Sounds like some of that, the negotiations are certainly moving forward from where we were, a month ago, for example. And I don't think any countries around the world want to get in this huge, big trade war because everybody loses, basically. So we'll see what happens, but we've seen it in the markets and whatnot that, with the rebound off of what may have been the bottom back there in the earlier part of April.
Yeah. Well, we are again talking with Chris McIntire. This is your game plan for retirement. We talk about all things money, finance, retirement planning, and the offer, ladies and gentlemen, is for you to get your game plan for retirement. It is a personalized plan with diversified strategies and long-term vision and goals to help you achieve your vision of retirement. And if you would like to get that put together, pick up the phone and give a call 419 332 0532 419 332 0532. You can also go online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. Any other things personally going on for you, Chris? I know probably watching a lot of hockey this time of year.
Yeah, I love hockey here, and the wife and I, have doing a vacation over to Scotland there, and enjoying some, a little bit of a reprieve. And we had to let our clients know that, hey, we're going to be taking a little break here, but given the market certainty, it's not like you can turn it off. And as you
No.
know, Peter, when you own it, you own it.
Yeah.
So
Well, and you still stay in touch, Chris.
Sure.
I know that you're checking in daily, and you've got a well oiled machine there with your staff at McIntire Retirement Services, able and capable of handling 99% of the work while you're gone. Other, things may slow down as far as the face to face and new client meetings for that temporary time where you are out of the country, but everything service wise continues pretty much unencumbered.
Yeah, and we went overseas last year for kind of a business trip, and then we did a brief jaunt into Scotland there last year. This year we're kind of perfecting it, and the unique thing is Heidi said, "Look, you're going to leave your phone with me, aren't you?" I'm like, "Be careful what you wish for." But when you own it, look, it's easier to stay somewhat connected than to fully disengage and then try to re-engage. To be honest with you,
Yeah,
as you know.
I've done cruises, Chris. I've done 3 and 5 and 7 day cruises, and did a 10 day. Three feels like you're shot out of a cannon. Like it's so fast. You're there, you're on the boat, and then you're back off and catching flights and stuff for that. 5, I think, is about right. 7, I actually got a little antsy. I started feeling like I was missing things and needed to get back
Yeah.
to work and check in more frequently. So anyway, enjoy your time away, Chris, but don't stay too long. We need you here, keeping us up to date on everything going on with our money, with our investments. And again, ladies and gentlemen, things aren't going to stop at McIntire Retirement Services. They've got the team there. They are looking forward to hearing from you if you've got any questions that you need to address, or if you'd like to sign up for a time to get together for that complimentary review, that visit, that retirement planning strategy session. When Chris gets back, pick up the phone and give a call, 419-332-0532. 419-332-0532. So Chris, thought we would talk a little bit today about times and opportunities to move your money. And not all of these are full scale relocations. In fact, several of these aren't requiring you to actually change accounts or institutions where your money is located currently, but a reminder that there is some maintenance that needs to be done from time to time. And during the midst of this volatility, it may be a good reminder that, hey, if you have not done these things in a while, it's time to check up on them. So, number one on the list, Chris, is rebalancing. Can you talk about how you help clients make sure that they maintain their balance at McIntire Retirement Services, and the importance of rebalancing those investment accounts on a regular basis?
Uh, Peter, when the market takes the stock market, let's say, right, because there is a bond market out there. Let's focus on the stock market. When the stock market falls in value, typically rebalancing is done on a quarterly basis. So let's say at the end of March, first part of April here. Um, and if the stock market is down significantly, a rebalance then shifts money from bonds back into stocks to keep your ratio where you want it to be. And we'll just use 50-50 just to keep use easy math here. If the stock market fell and your stock portfolio is 60%, your bond portfolio is 60%, then you could reallocate 10% back into stocks, which means you're doing it at a lower prices and you're kind of doing your dip buying. That's the importance of doing rebalancing. And, many investors don't realize that we do that. They're just looking at their statements. And, when you do rebalancing, you're doing that for future rates of return, and unfortunately, sometimes, we live in this instant gratification world. And, when you're investing for the long haul, it does take time. These things don't change in a month. You're talking realizing gains and whatnot over the course of years.
Yeah. There is a saying, Chris, time changes everything. And certainly as our age progresses, time changes our risk tolerance a good deal as well. And we need to be cognizant of that and rebalance again, like you said, for future returns, not back necessarily to the same allocation we had 10 or 15 years ago.
Yeah, I've got, if you're looking on the podcast, this came out of our investment folks at Brookstone Capital Management. It says time, not timing, is what matters. So it says if you'd have invested $100,000 in the S&P 500 over the last 20 years, it'd be $706,000 now.
Mm.
Okay. If you miss the 5 best days, it's 435,000 and change. So ducking into cash only cost you $260,000 to miss the 5 best days. Now, the people listening to the show here today are probably not 100% invested in the S&P 500. They probably have bonds, real estate, gold, commodities like that. But that's why it's hard to sell into cash because all of a sudden the market bounces 7% and then you say, "Oh, okay, well now I ought to get back in." And so that's the analogy there. And sometimes you have to have some discipline to stay in the game, obviously, and check your emotions at the door, right? If you remember that Brad Pitt line in Ocean's 11,
Hmm.
leave emotion at the door.
Yep. Um, there's also a couple different types of rebalancing, Chris. You mentioned the quarterly rebalancing. That is more of just a regimented system, strategic rebalancing, if you will. But there's also like tactical rebalancing, and I know from time to time we do want to shift things a little bit more proactively due to market conditions. Now, I know the chart you just showed talked about time, not timing. Is this contradictory to timing the market, or is this in fact something that benefits and complements the time in the market and not trying to time the market?
Yeah, it would certainly be a compliment, obviously, Peter. And an example of this is, in 2022, when they raised interest rates, the tech sector took a beating. Well, in 2023 and 2024, the Magnificent Seven took off. So that would be, kind of tactical, allocating a little more resources or assets in that tech sector space, for example.
Yeah. Again, we're talking with Chris McIntire, talking about some time, some opportunities, some reasons, and some strategic advantages to moving your money, ladies and gentlemen. Again, not all of these are full scale relocation. A lot of these just gentle reminders of routine maintenance or some strategic opportunities. Number two on the list, Chris, is Roth conversions. Now, this one is moving money out of one kind of account and into another, but this could be done at the same institution or the same location where your money currently is at.
Certainly, yeah. Well, we use Charles Schwab mainly here in Fidelity in our practice. So, we have a lot of clients that say, okay, I've got some stock in my IRA account. It's down in value. I'm going to move it into my Roth because I'm paying less tax. I don't want to sell the stock. I'm paying less tax on it. I'm going to move it to my Roth. So I'm converting it, okay, to my Roth IRA and then letting it go. Then you don't even have to sell that investment, right? So now you have an IRA at Schwab and a Roth IRA at Schwab or whatever financial institution you might be utilizing.
And key point there that you made, you don't even necessarily have to sell the investment. That you could actually like hold the same shares and just relocate them into that Roth account.
Yeah, yep, you're exactly right there, Peter. And if God forbid you said, "Oh, well, my goodness, doggone it, I sold the asset, I can't buy it for 31 days." You're doing it within your IRA, so you can rebuy it. Doesn't make any difference. If
Yeah.
outside of your IRA is where you have that 31-day wash rule.
And it's not an all or nothing proposition. You can do partial Roth conversions. You do not have to. And in fact, Chris, I know you spend a lot of time helping people figure out how much to convert, if any.
Yeah, absolutely. And a lot of it's a tax question. How much tax do you want to pay? What tax bracket are you in? And we typically want to help them maximize or close to maximizing the 12% tax bracket, especially for our married couples, because that's about $126,000 this year, maxes you out at the 12% tax bracket. So a lot of retirees have some ability to shift assets from an IRA into a Roth IRA and only be subject to the 12% federal income tax rule. Don't forget the state, obviously.
Yeah, but if you can get money out of a retirement account around 12%, Chris, not a bad deal, right?
Yeah, if some of this money's never been taxed for 30 years, you're just scheming off what the government lets you defer for a while and doing it in a very efficient manner because, you got to remember when you pass away, if you're not going to use your Roth IRA and you're doing this for your kids, the Roth IRA distributions for them are going to be income tax free, So if you're in a 12% tax bracket and they're in a 37% tax bracket, right? It makes sense for you to pay the tax bill, right? Not them.
Yeah, yeah. If you can make the comment, "Hey, I don't really need to worry about my kids. They're in fantastic financial shape." Like kudos, fantastic. That is great, but at the same time, you may want to look at some proactive tax strategies so that the IRS doesn't become your largest beneficiary, right?
Sure, or tell your kids, look, I'm converting my IRA to Roth for your benefit, but you got to pay the tax on my conversions. And let me know how that works out for you, folks.
Yeah, not a bad proposition, in all honesty. All right, so Chris, another moment here, and I think this is a big one for those within the retirement red zone, within that window, 5 to 10 years. But specifically, this comes at a benchmark of a key age. And I think most of us know this age. We might not know why this is the particular age, 59 and a half. It seems like an oddly specific number. Why not 60 or why not 59? I don't know. They met in the middle. However, it is 59 and a half, but 59 and a half is not only the age which we could start making withdrawals without the 10% penalty. There's also another key element of 59 and a half that allows us to take control of those employer dollars in the 401ks and our own dollars that we've put in there, the life savings that we've built up to that point. Talk about the in-service and why is this an important opportunity for people to understand?
Yeah, we talk about this a lot at the classes that we teach at the local colleges here as well, too, that 59 and a half rule. Most institutions allow you then to do what we call a direct rollover. You can take some of the money for or all of it in a 401k, even if you're still working there, putting contributions into it, and transfer it to an IRA. Okay? So, like if you've got a Fidelity 401k account, we can move it into a Fidelity IRA account and you just have a lot more wide range of investments. You could also move it to an insurance company if you wanted to create your own annuity, so you have your own kind of, you can get a lifetime income like your pension would pay you out of an annuity as well, and then determine when to turn it on. Just gives you a little bit more control. You can do some pre-retirement planning if you're not going to retire till 65. It may make sense to do some strategies ahead of that for sure, right? Better to be proactive than reactive.
And piggybacking this off of our last one, Chris, that Roth conversion, most 401ks, at least as far as I'm aware, inside the 401k, don't let you do those Roth conversions of dollars while still in the 401k. So if you did want to do that, the in-service distribution may allow you the opportunity to then begin making those Roth conversions.
Yes, absolutely. And being in control and having things ready to go, it's certainly easier to do outside in the IRA world because if you're going to do a Roth conversion, you can control where the taxes come out of it. If you have the 401k and you make a withdrawal, 20% mandatory tax withholding. Okay. So if you do that before the age of 59 and a half, so let's say you had an old 401k, at a place you used to work and you're not 59 and a half and you want to move that into a Roth IRA, right? You got to watch where you're going to pay the tax from because you're not 59 and a half as well. So, some of the little pitfalls, that's why it may make sense to work with a professional to help you do this. And if somebody screws up, they're the ones that are liable.
I read an article from Ed Slott, who is considered America's leading IRA expert, and he has got a special on PBS. We've featured him here on this program before, but this particular paper was about Roth conversions. He's a big believer and proponent in that, Chris. And he said that point you just made, he said that inevitably, whenever he is speaking about Roth conversions and talking about if you do this before 59 and a half and withhold the taxes, how that is considered a withdrawal and will result in the 10% penalty. He says inevitably there is some advisor in the audience whose face turns white, who didn't really realize that and then say, oh, I've made a terrible mistake. So it is something to be aware of.
Sure, yep.
You want to get these strategies right.
Yeah, absolutely. Mistakes can be costly, and sometimes they're honest mistakes, and it's an oversight, and but it does happen, right? You do enough transactions, you run into a little bit of everything out there, and it's kind of like missing your required minimum distribution. There's a penalty for that also, and You might not have done it intentionally, but it happens.
Yeah, that's maybe we should make this number nine. That's those RMDs. That's certainly a reason to move your money, right, Chris?
Absolutely. Yep.
Yeah.
Without question, because if you have three different IRA accounts, one at a bank, one at an investment company, one at an insurance company, for example, if they're all IRAs, you can take the distribution from all three of them out of one place.
Yeah.
Okay. If you have a 401k in an IRA, you have to take two distributions there. And remember, the 401k is going to withhold 20% tax mandatory, even if you're in a 12% tax bracket.
And also remember, if you are already RMD age and you do decide, hey, I'd like to consolidate these accounts, the 401k, the first money out of that is still going to be the RMD. So the first money out of any account that requires an RMD is always going to be the RMD. You don't want to end up paying tax twice because you took an RMD as a rollover and then it ended up in the second account. So anyway, Chris, we are talking about moments to move your money, and as the market is moving, some of these become more opportune. Some of them you may want to exercise a little bit of caution about as the market has been so volatile recently. But ladies and gentlemen, you want a plan to help you identify and to execute on these things for you. And that is why Chris McIntire offers to put together your personalized game plan for retirement. If you would like to get your game plan for retirement, pick up the phone and give McIntire Retirement Services a call. 419-332-0532, 419-332-0532. Unfortunately, Chris, we're hearing a lot about this. Well, maybe if it's on our own accord, it's fortunately, but if you are leaving a job or a job has left you, it's also time to look at moving your money.
Yeah, absolutely. And look, explore all the options and, make the best determination for you. You can sometimes craft a nice portfolio like we do for our clientele out of low cost exchange traded funds. And you might have been in a 401k with several mutual funds that may have above average expenses. So, internally you can start saving some dollars that way by using much more lower cost investments. And, if you picked a half dozen stocks or something like that, there's no cost to run a stock portfolio on your own, or even in our platform, Brookstone has some individual stock platforms, and there's no additional fee inside that piece there typically.
Yep. Um, But Chris, when you leave a job, I mean, the conventional wisdom, I would say vast majority of instances, probably 95 times out of 100, if not more, when you leave a job, you should take your money with you because there are many orphaned 401k accounts out there not getting the maintenance, not getting the attention, possibly not invested the right way, possibly paying too much in fees that people have forgotten about. And then eventually there are those commercials on TV. Do you have lost money? Do you have found money out there? Sometimes these 401ks get rolled over themselves into a place you don't even know where they're at. You can lose track of your money. Take it with you. And also generally don't roll it into the new company's 401k.
Yeah, and I'll give you an example. You got a 401k at an old company, and you said, "Look, I just got it in the money market there. I don't want to lose any money on it or anything." And that I get that, but you can roll that into your new IRA account and keep it in a money market as well. And then you're seeing the statement maybe a little bit more active, and God forbid if your risk tolerance changes, then you can do some different types of investments and whatnot, and a lot of times people miss opportunities, because they're headline and emotion driven. That's for sure, Peter.
Well,
And we're human. I'm not, being just that's not a disparaging comment, but sometimes you got to turn the news off, go for a walk, and and let this thing work itself out because it's hard to sell at the bottom, and then you miss, like we said, the best 5 days, out of the next 2 months, and you crushed your returns basically.
Chris, making a transfer, if we are going to change locations or institutions, does not always involve selling out of the existing positions we have either, though, right? If we do those kind of institution to institution transfers, those positions can be held intact and relocated.
Yeah, absolutely. Yeah, we're transferring dollars all the time, millions of dollars throughout the course of a year. And, a lot of those we transfer in kind, so they stay invested. And then we'll take a look, meet with the clients once we get them over here to say, okay, here's some additional strategies we'd like to do in replacing what you have. Or, hey, here's some stocks that you have that we think are just fine. We want to keep those as well.
Yeah.
Yep.
Chris, we've thrown a couple extras in, so I'm going to combine for the sake of time. Fees are too high or underperformance. Are these reasons why we should consider moving our money?
Yeah, without a question, and look, I'm a fee-based planner, so we have to justify how we get compensated as well. And so we want to use low-cost investments there, eat exchange traded funds as an example, versus maybe some higher cost mutual funds. We want to save those clients dollars. Obviously, we want to do better as they do better.
Yep. Well, again, ladies and gentlemen, if you would like to get together your game plan for retirement, identify any of the items on this list. Is there a time, cause, reason for you to consider to do anything different, or are things squared away? During our working career, we are not as exposed to, we do not face many of the same risks that we will encounter once we are retired. So, is your current plan set up and structured in such a way to face those risks that you will have to address into the future? A lot of times we have to back up and revise how we are handling and approaching the investments in order to do so. And if you would like to have that conversation with an experienced, qualified professional who has seen retirement many, many, many times over and helped people through it, seen what has worked and what has not, pick up the phone and give Chris McIntire a call, 419 332 0532. 419 332 0532. Chris, during COVID, and I think again right now we're seeing a lot of people who are backing up and reassessing their timeline. If your timeline has changed, whether of your own wishes or something outside of your control has changed the timeline. I planned on working 10 more years, but actually I think I'm going to only work five, or I thought it was going to be five, and I'm coming to find out I need to retire now. If those kind of big changes have happened, we need to reassess the plan, and that may be a moment to move your money.
Yeah, absolutely. And, hey, these are gut check moments, when you start talking trade wars, because nobody listening to the show right now has experienced this, what could have been a significant trade war. I mean, there's some emotion there, especially if you're saying, look, I'm stopped working, I'm cutting off the paycheck. I got to draw out of what I was saving. I don't want it to go down in my investment portfolio. So, some folks may elect to work a little bit longer and, maybe they really like their job and they're not too stressed in that environment. And they say, "Ah, I'm just going to ride this out on the other side of it. I'm okay. I got vacation time and whatnot." If your job does stress you out pretty significantly, you need to reevaluate and make sure, things are still on course. And, because we always have somebody that's getting ready to retire that we're working with at any moment. And so a couple of examples right now that it certainly is an emotional piece. And as I get a little bit older myself, you really can experience and see that emotion on the clients and get a better understanding on it as well.
I guess you're right. Is I gave the examples of that time horizon shortening. We could get into a position, hey, I actually enjoy my job and want to keep going a little bit longer. If that has changed, is again time to reassess the plan. Finally, Chris, on our list here, consolidating accounts. We may feel that having accounts spread out across multiple locations is an inherent safety mechanism, helps with diversification. What we have found is that oftentimes that actually hurts diversification, can lead to duplication, often lower performance, higher costs and fees. There are reasons to consolidate accounts, if not for just the ease of keeping track and paperwork.
Yes, you're right, Peter. When I was just doing one of our classes at Terra Community College, and there's a couple of PowerPoint slides that says, 8 asset classes is more efficient than 22 asset classes, right? You can over diversify just like you can under diversify, and it's finding that right balance. And an asset class would be stocks, US bonds, international bonds would be another asset class, real estate, commodities, things like that is what we're referring to.
Well, ladies and gentlemen, all of these are always going to be personalized for you and your situation. If you come in and speak with Chris McIntire, the team from McIntire Retirement Services, you get your custom game plan for retirement. It is the written plan. It has long-term vision with diversified strategies. If you'd like to see how that can help you improve your lasting financial confidence into and throughout retirement, pick up the phone and give McIntire Retirement Services, Chris McIntire, a call. 419-332-0532, 419-332-0532, or you can go online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. Chris, we always appreciate the time. Thank you for being here, leading the way and giving us the guidance.
Hey, my pleasure, people. Peter, thank you everybody for listening. God bless America.
Tune into Chris McIntire's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Guarantees are backed by the financial strength and claims-paying ability of the insurer. Please refer to our firm brochure, the ADV2A Item 4, for additional information.